Welcome to the True Wealth Podcast, where we specialize in helping aspiring homeowners break into the real estate market and help investors create and build wealth through real estate. We will be sharing some of our best advice around real estate so you can purchase your first home or reduce taxes and achieve financial freedom. Your host, Sean Adeyemi, is a certified financial planner, mortgage professional. Financial freedom is possible when you have the right mindset, coaching, advice, and community. So, let's get real.
Welcome to the True Wealth Podcast. I'm your host, Sean Adeyemi. Today, we're going to be talking about financing when it comes to buying U.S. real estate properties. This is part 3 of our conversation with Cher, and Andrew was on the first episode. And on the second episode, we had Carmen talking about how to own your property, the different tax structures. If you missed those, check the link in this episode so you can go back to watch or listen to those so you can get caught up on the conversation. But today we're really going to be focusing on just the financing aspect of it. How does a Canadian finance their purchase of real estate in the U.S. without having U.S. credit, without having anything really in the U.S.? You're just Canadian, have no status or anything in the U.S. So how do you go about it? And Andrew is joining me for this call today. Andrew, how are you today?
Good. How are you? Thanks for having me again.
Yeah, I love it. So we've had this conversation offline a lot, and I know there are different strategies as we have clients who are currently going through the process of purchasing U.S. real estate. But can you talk to us about the different options that are available? Now, before you get to that, I know that 5 or most of the major banks, so your BMOs, your RBC, your TDs, will finance acquisition of U.S. properties because most of them have U.S. arms that can do that. But even that comes with a limit. By the time especially if you already own a property in Canada, by the time let's say you use leverage to buy property in the U.S., or even if you use cash as your down payment to buy the property in the U.S., depending on your income bracket, that may cap you at 2 properties or 3 properties at most. So How do we go about it? What about a Canadian that cannot even afford to buy property in Canada because of, one, the cost of even buying Canadian real estate and the high income needed, depending on where you're buying, to buy property? So what about those who cannot even own in Canada? What are their options, and is it possible to own in the U.S. first?
Yeah, so there's a few different ways we could slice this. So let's just take the case where, a Canadian does have an income, maybe dual income, but just slightly priced out of the Canadian owner-occupant market. Let's just call it in Ontario or BC or wherever it might be, just slightly too expensive, and they can find a more cost-effective home in the U.S. They have one of their options is going to the U.S. arm of a Canadian bank like RBC, TD. Some of them have an investment mortgage for buying an investment property in the U.S., but I'd say of them all, RBC is the one that probably has the best one where you can actually buy an investment property for long-term investment. You would have to hold it under your name, but you could leverage your Canadian credit. And obviously, if the price point's a bit lower and within your sort of debt ratio, then they could give you a mortgage on that. And those are typically, let's call it the lowest rate mortgages, where you're using your personal credit and buying it under your personal name. And then, all the other Canadian banks also offer sort of a short-term rental property. Like, for example, TD and all of them have one for, so if you were looking for like a second vacation home, they could lend to you in that. But that's slightly different outside of like a long-term real estate investment product. This is for more of like, hey, I'm a snowbird. I want to buy something in Florida, and I'm going to be there like 3 to 6 months out of the year. So they'll let you kind of leverage your personal credit to buy that house. Now, go ahead.
Before we actually dive a bit deeper, so you said short-term and long-term in terms of what they would allow you to do. What does that mean? Like, what does the bank see as a short-term?
Yeah, good question. So the sort of criteria is the lease agreement. In the lease agreement, it has to say that the owner has the permission to come and stay at least 2 months of the year in the house.
Oh,
So that makes it a vacation home, right? And
right.
then a long-term tenant wants to stay there and does not want to be kicked out on an ad hoc basis
Mhm.
for the owner to come and stay. And so that is the fundamental difference between the short
Oh,
term and the long term. Whereas, yeah, your second vacation home versus renting it out to a tenant that and you don't intend on using it.
so when the Canadian bank is financing you, they're looking at it as not just an investment property, but as a vacation home. So there's a stipulation in part of their underwriting requirements that that property needs to be available at least twice or 2 months of the year. So that's what
Yes.
is the short term. Got you.
Yeah, and like that's the very popular product for TD, and RBC has that too because there's so many Canadians buying vacation homes in Florida. So
Hmm.
for that specific reason, they've created that. But then RBC has a separate one where it's you can say, I'm looking to buy an investment property. I'm not going to stay there, but I just want to buy an investment property, leverage my personal credit, and buy this
Right.
house. And I'd say like that is similar to like, an American where they can go and say, hey, I'm going to knock on my own bank, like the Bank of America or Chase, and say,
Mhm.
hey, do you have a long-term investment property mortgage that I can leverage my own credit and get the best possible rates?
Mhm.
And most of them do. And every bank has sort of their own criteria. But for Canadians looking to buy long-term sort of investment properties, there is a specific mortgage that a lot of repeat real estate investors use, which is called the DSCR loan, which is a debt service cover ratio loan.
Okay.
Um, and the closest equivalent that Canada has to it is the commercial loan, where the lender underwrites the house as a business as instead of the borrower. So your personal credit doesn't really come into play. So
Okay.
they're really going to look at, hey, what does the market say the rents could be on this house, and does it cover all your hard costs such as property management, insurance, utilities, or maybe not utilities, tenant pays that, but property tax, property management, and insurance. And if it can cover that ratio, they'll lend to you a million times over. And the beautiful thing about that too, it's typically a non-recourse, meaning minimal liability, personal liability, and doesn't require credit. So again, looking at it as a business.
So thinking about that, also trying to think of an equivalence on the Canadian side as a mortgage broker, for instance, when we're helping clients buy investment properties, many of the lenders on the prime side are only counting about 50% of the income in addition to their other sources of income to qualify them. On the alternative space, some lenders may go as high as 75. In rare spaces, they may go as high as 100. But in this case, it's completely different. They're taking 100% of the rental income from that investment property and looking to see, based on the rates available, can the rental income cover this mortgage, the total rental income?
Exactly.
Okay.
Yes. Yeah. And then based on that coverage ratio, you can get, good, bad, worst terms. So obviously, if you can cover to its greatest degree, you get the same sort of terms. And the terms is what actually makes it a very viable product and actually probably makes what investing in the US so appealing is because it's so much
Mhm.
easier to scale your portfolio,
Right.
is the terms of these DSCR loans. They're the kind of de facto is the 30-year fixed rate term
Mhm.
with minimal to low prepayment penalties, meaning, if you can get it to be cash flow positive in this high interest rate environment, you're pretty much saying this is battle tested. And as soon as the rates drop, I'm going to go refinance, and this thing is set for another 30 years. And I don't have to think about it. Um,
That's one of the neat things I love about the US mortgage is
yeah,
get that fixed rate and you're locked in for as long as you want it.
yeah,
Right. On the Canadian side, we're having to renew our mortgages every 5 years. And I mean, everybody knows at least the last year or so, there's been a huge rate shock where people's interest rates have gone up from the low 2% to the mid fives, sometimes 6%. So there's that big mortgage payments almost doubling. But in this case, especially in the high interest rate environment, it's almost kind of like a good time to buy now because if you're buying and you can qualify and there's enough income to cover that mortgage in this high interest rate environment.
Mhm.
On the US side, when you said there's no prepayment penalty or very low, it means when rates drop, I can come back in and refinance. Now my mortgage payment has dropped and I've increased the cash flow in my property.
Yep, that's correct. Yeah. So that's kind of what we talk with every single one of our clients is like, okay, if we're going to come in with a mortgage, let's anticipate a refinancing in like 3 years.
Mhm.
So as we're going out and shopping for a lender, we'll see who's got sort of the best rates with the lowest or no prepayment penalties after year three. And then we'll set a notification to resurface that once as rates drop and then recoup probably 50% of their capital and go out and get another one.
So you mentioned something earlier that I want to circle back on. You said that the rate you get may be dependent on how much the income covers the mortgage.
Yeah, so each lender has there's a million qualifying criterias and they all kind of differ between clients, but let's just say the name of it has to, it alludes to the debt service cover ratio. So
Mhm.
some of them have sort of their minimum thresholds, and then some will go below that. So for example, if your profit ratio is like 1.25 in terms of coverage, you could probably get the best rate. And
Mhm.
then some are willing to go into the negative space, but then your interest rate starts ticking up higher,
Right,
right?
right.
So, but some clients prefer that because they know that over a couple of years, um, again, because these are landlord-friendly states, the rent rate you can increase to
That's
market year over
right.
year can, it eventually start catching up. And then as it catches up and it exceeds, then that's another opportunity for them to go out and refinance as well.
So other than the debt cover ratio, what else affects the rates?
Yeah, so for Canadians, without any sort of established credit, there might be a rate hike, but a lot of them are okay with that if as long as sort of your down payment is higher. So Canadians coming in for the first time will typically get hit with like a 30% down payment requirement,
Mhm.
in addition to making sure the debt ratio coverage is there. And then there's a few different minor stipulations like the type of entity you've got set up and the
Mhm.
cost structure around there. So I know Carmen went into a lot of the sort of entity structures, but that is sort of one of the criteria or one of the filters we took at it when we said, here's an ideal structure, is that these lenders look at these entities that we're forming for Canadians
Mhm.
as an acceptable vehicle to lend to.
Okay, so how the entity set up, and I guess they're looking at that from a liability perspective, which is also an indicator of how risky the mortgage is. That's why the entity setup also affects
Yeah.
the rate, I'm assuming.
Yeah, that and like if there are a million layers, because they still want to trace it back to a human to make sure that there's no money laundering. So like if there's a
Right.
entity on top of an entity on top of an entity, then they've got to do diligence on all of them, tracing it back to a human. Because, but I would say like that is if that's all that it takes just to get that vetting to get it done, I would gladly pay the upfront fees for that.
Right. So entity, the type of entity, loan to value. I'm glad you covered that because that was my one of my next questions is that um, how does loan to value affect the rate? The higher the down payment, the lower the rate. What's the average range? For a newbie investor, you said 30%. Is that the norm, or are there opportunities for 20% down? And how does that affect the rate?
Yeah, so this is the US, so it's quite interesting. So let's just say 30% is the most rigorous sort of entry point for a Canadian.
Mhm.
And then we do have lenders that can go down to like 5% eventually, but those interest rates will be much higher. In a normal interest rate environment, one could potentially pull that off, right?
Hmm.
So as we establish your credit and as the markets improve, there are all these different permutations of a DSCR loan that we can go after, that opens things up.
So I'm curious. You said 5%. I know that's available for U.S. residents. Actually, U.S. residents can even go as low as 3%, depending on the type of property. But I've never heard 5% before. So,
These would be egregious terms in this rate environment. My guess it would be like in the teens. So
I-
I don't think anybody would ever go to that. But there is a time and place for that. But there are also these other loans that we could probably piggyback if 5% is really what you want to go in at. But typically, I haven't seen anyone say like I'll opt for a 5% down payment option. It's just it doesn't make sense there. But there are
ridiculous to do that because
yeah.
If your rates are in the teens and you don't care about the rates, it just means that even after all the expenses paid, you're still cash flowing a lot. That's the only situation where I wouldn't look at doing that, especially when I know the market is on an upswing. I can always refinance in a few years and get into a lower rate, but the cash flow has to be like amazing.
Yeah. I just like the fact that the option is there. And yeah, if the cash flow is amazing, why wouldn't I go in for a 5% if I can make the numbers work, right? So I get to hold more of my cash and this thing is cash flow positive, then let's go for it.
So other than the house, and yes, you said the entity, what are they looking at? Who can get this type of mortgage? You mentioned no credit needed. Does actually having U.S. credit help, or it doesn't matter?
Yeah, I would say U.S. credit helps. You can come in at like a lower down payment. So after your first home, after coming in for 30, then you could probably come in for 25, and then let's call the norm in the normal interest rate environment is 20%. 20 to 25 is for a foreign national. So 30 is a bit higher than normal, but I think that's, again, because of these higher interest rate environments, a lot of these lenders are tightening up their qualifying criteria.
So having credit does help if you do have credit.
Yeah, and like some lenders actually care more about your track record as an investor than your credit. So they want to see experience. Again, they want to know that you can pick winners. That like we've done some loans for clients where the lender has asked for their experience and they have like a different tier system of prices. And then when they say, what's your experience? You actually have to provide like this Excel spreadsheet with the address, date purchased, the renovations, like what you actually put into it and what it's actually yielding today. And then they're actually going to scrutinize that more than their actual credit report. They don't actually pull your credit. Like if you're a shortfall, then maybe they'll pull your credit. Like if your debt ratio isn't there, they maybe pull your credit. But like they've asked for their full list of real estate transactions that they've actually pulled. And some of them have a higher criteria, 5 homes or more, like that they've like previous track record. So each lender has their own recipe.
So if they're going that deep on your experience, I'm just curious as to how they even do their due diligence. What if you've done flips? And
yeah, they would ask you that for that too. Like if it was like but there are actual specialized fix and flip loans, and I don't want to like, expand the scope of this, but these same lenders do have like these renovation or fix and flip loans that they can offer for like 6 to 12 months that can help you get into a long-term rental home that is a fixer upper. And then after those 6 to 12 months, then it transitions into like a DSCR loan. But those right now are excruciatingly high right now. So not guiding clients to go to that path right now, but in the future.
So it sounds to me that anybody, if you can demonstrate you have the down payments, 30%. And honestly, if we're looking at a C-type property in the 200s, 30% is
roughly 60K, 70K.
Roughly 60K, right? 60K will barely buy me a house in Canada.
I think you can buy 2 Toyota Corollas. That's pretty much it.
Right? That's about it. So even at that sounds pretty attractive. The key would be having enough to also cover the closing costs and all of that. And what the experience that share brings in, that would help with mitigating the hassle that comes with owning that property. Now, do the lenders look favorably or unfavorably at having a company like yours helping to manage the property when it comes to the experience portion of getting the mortgage?
I'd say yes and no. So yes, only because we do have some lenders in our network that, so to that point where I mentioned the track record of the investor, is pretty important sometimes. Where if we say, hey, Share's bringing this client to you and we've done a lot of business together, consider them experienced because they're piggybacking sort of our track record because we
Right.
help. So it's more of those who know what we do and
Mhm.
have worked with us that can kind of give us that ability to stretch our experience over our clients' track record.
So there is an advantage to working with you guys because if you've partnered with these lenders and you worked on multiple deals with them, and especially if it's not the investor's first time, then their experience, even if it's just one property they've purchased, and then your experience sort of helps with the underwriting and makes it
Yeah.
more favorable for the lender to take on.
Yeah, and it's very easy too because we know exactly sort of the format, what they're looking for. So we're just like, here you go, let us know. Nice to see you again, John. Like, so yeah, our track record extends to our clients.
I kind of see that as similarities in what I do as well, because sometimes because of the number of deals I do with a specific lender, when I put together a package and submit to the lender, most times I get an approval, and I get an approval quickly. I get an approval with favorable terms because based on my track record with them, the type of files I send them, they know and they've seen my notes, and there's a way that I organize my files that the underwriters love it. And so in a way, a borrower that may not get the benefit of the doubt from a different lender or from a different broker, they give them a little bit of a benefit of a doubt because they see the due diligence that I've done on that file, and they're most likely to approve it. Now, I'm not saying it's purely based on me. The file itself still has to have its own merits,
That's right?
But in the same vein is what
Yeah.
those lenders are looking at, right?
Yeah, totally. Yeah, I think that's the exact parallel.
Okay. Any other alternatives? Anything else you want to add that you think is relevant to financing? And
Yeah, like I think the financing piece is, I think, one of the biggest reasons again why I think investors should look in the U.S. because you don't know what the economy is going to do and what direction it's going to go. But this is a very specific mortgage for average mom and pop investors that are looking to buy single family homes, right? Like that's how specialized this market is in the US, that they've got a specialized investor mortgage to protect investors. They don't want another '08 mortgage crisis on their hands. They want to be able to fix these up, understand what their bottom line is, and make sure that people can continue and build wealth for themselves and for their family. So when you think about investing, again, as a Canadian in the Canadian market, you've got to think about, how are you leveraging your personal credit to a certain degree, what that's affecting in terms of your other investment portfolio. And then how well are you protected from the downside? Like if another sort of high interest rate environment comes along or your renewal period comes up, are you really going to be able to forecast what your bottom line is when you're stuck on this variable mortgage that is tied and exhausted your personal credit, right?
Yeah. One thought that I just thought to ask is, I know on the Canadian side, typically, even if it's an investment property, the lender wants to see the source of the funds. Some of the hardest files I've ever done are those that are international, and some of the down payment is coming from overseas. How does that apply in a situation like this with the lenders when the down payment is coming from Canada?
Yeah, that's a good point. So lenders have different seasoning requirements. Some require 30, some require 60, some require 90 days. Some are okay with, like, if you have it in a HELOC, that you can provide a HELOC statement for the last 3 months. So
Okay.
yeah, so there's all these different qualifying criteria, and yes, there's a handful of these lenders that work specifically for foreign nationals, and they will take your HELOC statements in Canada that you've had for X years, and they just want to see that your name's tied to it. But in the case where, and typically when it's a HELOC scenario, we'll guide the clients to say, hey, let's just keep it there because there's no point in pulling that out and eating a month of interest up front, right? So if it is true non-interest bearing cash, we'll help you open up your bank account in the US, sit it in there, and then let it season while we're searching for a house. And there's a ton of banking options there we'll set you up with that no fee business banking with free domestic and international wires.
So do they take like the Canadian statements for your BMOs, your TDs, your investment accounts? Like if I found a house today, now granted it'll take at least 30 days to close it, but considering the fact that the funds have not been in the US at all, will they take just my Canadian statement to verify the source of my down payment?
Yes, so that is like yeah, as opposed to the seasoning, they'll take your statement. But then what that opens up, and it's more of like straight kind of a, if you were to take it as an approach, if it was a HELOC, the obvious next question is, can you service the HELOC debt? Because they'll take that into the whole debt coverage ratio formula and see, okay, now if you're going to use the HELOC statement, show me that you can service the HELOC cost plus the mortgage, et cetera, et cetera. So therein lies another hurdle, but one that we can figure out before we go into that sort of qualification process.
So they're looking at the HELOC balance or what's available. They're most likely doing exchange rate conversions because 100,000 Canadian is about 17,000 USD. They're also looking at that HELOC interest rate, and then they're looking at what your down payment requirement is for that property. Now, how are you justifying your ability to service the interest rate on that HELOC? Like, what do you have to show?
Yeah, so in that case, you might have to show them sort of like your tax returns or some like your net income, or just fill out a form. So it depends on the scrutiny there, but like in most cases, what they'll look for is some sort of like proof that you've got other income streams to cover any shortfall.
Sure.
So if you're using HELOC plus a DSCR loan and the debt does not cover all of the cash flow, or the cash flow does not cover all of the debt, then they're going to be like, okay, can you make up this $100 shortfall on a monthly basis? Show me. And then they might be like, yeah, show me your T4 from last year. Okay, yeah, you make enough.
In what cases have you seen declines? Like what? I mean, I would assume that even before you present a package to a lender, you're most likely going to get an approval.
Yeah.
But odd case that may throw a curveball, and I don't know if you've seen that. I guess that's where my question is.
Yeah, so when we were sort of early stages of this, we did get shut down, but it was more of what kind of company we set up. So the client was trying to buy it in a Canadian corporation, and that was a non-starter. It has to be a U.S. entity of some sort. They won't take a foreign entity. Gotcha. So that was the only one. But there's always a lender that we can find with reasonable terms, or slightly worse than what we anticipated, but never any sort of like not a single lender would offer up a product. Never been confronted with that. So knock on it.
And that's a good thing, because it means that you've gone through the different lenders and the different possibilities, and knowing upfront that Canadian entities are no-go. When you're presenting these options to the lenders, you're most likely going to get an approval. So this is really fantastic. Honestly, if you have the funds and you can't get into the Canadian market, I see no reason why to get into the US market. Now, like with everything, there's always risk. And part of my job as a financial planner, and part of Andrew and the share team's job, is to help you do the due diligence. There's never an issue or never an instance where there is a compelling, you have to do this, a high sales tactic. No, this is only for the right type of investor. So even though we say this is possible for you, there are opportunities there, truthfully, it's also not for everybody. And I'll be the first person to say this is not a great idea for you. You don't have the means to support it, or you don't have the means to, if a worst case scenario happens, cover whatever is needed. So I like the approach Share has, and this has really been informative and great. Andrew, anything else you want to add before we wrap up?
Oh, that's it. I mean, if we can find those deals using the high interest rates today, battle tested, you're secure for life on that property.
Yep. Thank you very much, Andrew. I really appreciate your time. It's been
Thanks
a
for
pleasure.
having me.
This has been the True Wealth Podcast. See you next time.
This is all the time we have for today. Thanks for listening to the True Wealth Podcast. Don't forget to rate, share, and subscribe to the True Wealth Podcast on your favorite podcast platform. Follow us on Instagram, Twitter, or Facebook at True Wealth Pod. We'd love to hear from you. Share your thoughts, ideas, and questions with us on our social media platforms or email us at podcast@truewealthadvisors.ca. And who knows, your question might be the subject of a future episode.